Bitcoin hit new highs on optimism for an incoming Trump administration support for cryptocurrency as the S&P hovers tantalizingly close to new all-time highs. One financial risk management expert does see some signs of exuberance, and we're going to talk to him today on Open Interest. Hello, everybody. I'm Mike Coe. Welcome to Open Mic. Sarah Eisen hosted Michael Saylor on Money Movers on CNBC earlier today. MicroStrategy currently owns 439,000 Bitcoin, and I think we may have a clip from that segment. And if we do, we're going to play it right now.
And Michael Saylor, well, you're the guest of the moment. So is there a limit to how much Bitcoin you're going to acquire?
No, I've said we'll just keep buying the top forever. Every day is a good day to buy Bitcoin. We look at it as cyber Manhattan. I would have bought Manhattan 100 years ago, 200 years ago, every year for the past 300 years. You pay a little bit more than the person that bought Manhattan before you, but it's always a good investment to invest in the economic capital of the free world.
So it's certainly true that in the long run, investing in marquee assets such as Manhattan real estate has proven to be a good bet. However, it is also true that even the best assets don't trade higher in a straight line. So today I'm really pleased to be joined by Bret Friedman. He's the managing partner at Winhall Risk Analytics, and he has some thoughts on this for us. Bret, glad to have you.
Thanks for having me.
So I know you've been taking a look at Bitcoin. Why don't you share, some of your thoughts and what it is that you're looking at, and how people who are involved in the space, whether they are trading the futures, whether they are, mining and buying bits of the coins themselves, or trading some of these ETFs, or even the really levered plays like MicroStrategy. What is it that you're looking at, and how should people be thinking about this right now?
Personally, I'm a futures trader and an options trader. I mean, that's my background, so that's how I look at markets. I'm not that concerned about what the underlying is. I'm more concerned about the technical metrics I can get out of the futures curves and out of the implied volatility curves to determine whether I'm interested or not. Obviously, Bitcoin has been going up like gangbusters since the election, since November 5th. The question on everyone's mind, the question that I'm getting consistently from people who aren't even involved in financial markets all that much is this turning into a bubble? Is this a nascent bubble or a bubble in training? So to me, there's a couple metrics that I look at, as well as things that I'm picking up, things that I hear people say that indicate to me that there might be some caution. But so far, over the indicators, the indicators that I'm looking at are not really signaling that this is a bubble just yet. And the indicators that I'm looking at indicate that this is a fairly orderly market that happens to be, an aggressive bull market. There's a real, determining whether something is a bubble or just an aggressive bull market is a real art. But luckily, there's some things in options and futures that you can look at to determine whether, where are we in that dichotomy. So
I think we might actually have a couple slides that you sent us, and so perhaps somebody in our crack production staff can pull that up for us, and we can have a look. So,
right. So
yeah, here we are. This looks like the Bitcoin futures chart. Tell us what we're looking at here.
These are Bitcoin options from the CME. Of course, I get all my data from OptionsMetrics, which is one of the world's largest supplier of implied volatility data, and more importantly, it's good implied volatility data. There aren't that many people that supply it consistently on a daily basis. But regardless, this is the 30-day continuous Bitcoin futures options skew. So what is this? So this is basically the out-of-the-money options versus the at-the-money options. So in very fluffy, bubble-licious markets, if you will, people tend to buy out-of-the-money options because they're absolutely cheap compared to at-the-money options, just in numerical terms. So people tend to move into out-of-the-money options, and they tend to bid them up in relation to at-the-money options. So you can see that the skew that difference in implied volatility basically means how much more are people paying for these things? Are they getting irrational on how much they're willing to pay for an out-of-the-money option? Currently, it's running around 7.5%, something like that, 7% for the 0.2 delta versus the 0.5 deltas, which, as you can see from the chart, I mean, it's a little spiky, but it's not abnormal. You know, it's not like we're seeing a 20% difference or something like that. As a matter of fact, just for regular old volatility, implied volatility, if you look at it, I mean, Bitcoin's trading around 60%, which is where it was trading right around November 5th. So implied volatility has not really gone up with the price, and you would kind of expect that when prices move up. But what it's also telling me is that the market is fairly comfortable with moving up, that people aren't putting a premium, an anxiety premium, as it were, in the market. What you will see, however, if Bitcoin starts coming off, you'll see implied volatility. I'm pretty sure you'll see implied volatility spike pretty seriously. So it's kind of an asymmetric market. They're comfortable with what implied volatility is telling me is that they're comfortable with the market going up, and they're probably not going to be all that comfortable when the market starts coming off. So that's what implied volatility is showing.
And what you have another chart for us as well, I think.
Right.
So yeah. This is what are we looking at here?
So this would be again the Bitcoin futures, and this is the shape of the curve. So you have different contracts trading, you know, nearby to deferred contracts. So I took the 30-day continuous futures contract and the 60-day continuous futures contract and subtract them out. So for whatever reason, Bitcoin trades in contango, i.e. the nearby contracts are much cheaper than the deferred contracts. A lot of commodities that don't have storage, I mean, that's the classic commodity shape is contango, because things that are in the future cost more than the things that are current because of storage, et cetera, et cetera, et cetera. In most commodities, though, without storage or where storage is free or doesn't even enter into it, like Bitcoin, you would see the opposite. You see backwardated. But for where the front is more expensive than the rear. For whatever reason, Bitcoin trades contango. There's a lot of things strange with this product, but whatever. It trades contango. So the question is that the contango curve is actually getting steeper. And what you would expect in a bubble, in a contango market, is people would move into the nearby contract and flatten the curve out rather than it getting steeper and steeper. It's about, this curve was done about a week ago. It's about the same currently. So instead of the contango curve getting flattened, they're buying the deferred contract, which means to me that they have confidence in this, that they're not just going into the nearby, that they're going into the deferred contracts as well, so they're confident in the bull market. And the last thing I was looking at, I think we have some charts from the CME, would be, that would indicate to me a bubble is forming, would be excessive volume or open interest. Open interest in the micro Bitcoin contract is indeed a lot higher than it used to be. Volume is not, it's not extraordinary. It really isn't the way that I would expect, that I would see in a bubble type market. So these three things are telling me, these technical indicators are telling me that it's not, it's just an aggressive bull market. It's not really a bubble. Possibly yet, but currently not.
Yeah. I think I actually have on my screen right now, I have at least 4 different lookbacks on the CME Bitcoin futures up on my, there we go. I'm being told that I have not enabled this screen, so I'm going to do that very quickly. But I actually have the CME Bitcoin futures up over here, and I'm going to see if I can get this so that the production staff can actually see that. Hopefully they can see it now, and I don't know whether Bret will also be able to see it. You were just talking about how, number one, it was trading in contango, and
Correct.
Again, because there's a little bit of an audio issue here, I also was a futures trader. I used to trade natural gas options on the NYMEX.
Oh, good.
So just as a reminder for everybody who is not familiar with what contango and backwardation is, what Bret is referring to is the relationship between longer dated futures relative to the near dated futures and spot. And what we can see here is that that Bitcoin futures are trading in contango. That means that the longer dated futures are higher. That's not always anathema in financial futures contracts. So what he was pointing out was that if you were looking at, say, for example, something like the S&P and S&P futures, anything where there's a carry cost, and there is not some kind of short-term supply disruption, this would sort of be the normal order of things. And so you would see that, you oftentimes will see that in financial futures. This can invert if you have a situation like, for example, if an index that is being tracked by a futures contract pays big dividends, so such that the net present value of the dividends actually exceeds the forward net of interest expense, then you might see something like a flat or actually backwardation. Where you also will see backwardation is when you have short-term supply-demand disruption. So in products like natural gas, which I traded, if there is, sometimes at the shoulders months, you will see some very strange dynamics, especially during the withdrawal season, where a short-term lack of supply can create severe backwardation in the curve. But as you can see here, the curve is relatively flat. Some contango, that contango has steepened. I'm on the chart right here. I'm just going to try to highlight these so everybody knows what they're looking at. Now, of course, since Bitcoin's been going up, you can probably figure out what the time series that we're looking at here is. But this is a year ago, the Bitcoin futures prices. These are from June. So that's 6 months ago, basically. The blue line that I'm highlighting now, that is, just over a week ago. And then, of course, the white line that we're showing is the present day. Okay, so Bret, before we let you go, I just wanted to know if you had any other final thoughts. We would love to have you on again, I have to say, and in fact, we would probably keep you around for the Q&A period, and if you have time for that, if anybody has any questions for Bret amongst the viewers that are on right now, the only issue we're having is that there's a little bit of an audio thing going on here. With your audio, it's sort of going in and out, so I don't know whether we'll be able to get that solved. But let's just say I'll keep you around for a second so you can overhear some of the questions. I think you can hear me pretty clearly, and then we'll see how it goes. Monday Morning Quarterback, welcome back. Thank you for watching. Is asking if Bitcoin drops, say, 50%, assuming Saylor stays committed, MicroStrategy, would it still be solvent? So, so here's the interesting thing. I don't know, Bret, if you have any opinions about MicroStrategy, if you follow the company, I'll just make a quick mention of something myself first, and that is that, one way we think about things like banks. So if you were looking at a money center bank, one of the things that we often look at when we look at a company's balance sheet is the tangible book value per share. So the tangible book value per share is effectively the value of, the company's, net assets, if you will. So of course, in the case of MicroStrategy, they do have some other software-related business. It's de minimis compared to the speculation that they're doing on Bitcoin now. Obviously, if the value of Bitcoin falls, then the book value per share is going to fall. That doesn't necessarily mean that the company is going to be insolvent, and I should point out that MicroStrategy is trading at an enormous premium to the book value of the Bitcoin that they hold. So I would just make that point. So the solvency has to do, whether or not the company is solvent, has to do with whether or not they're going to be able to meet their financial obligations, such as repaying the converts that they've been issuing. Not all of them are zero coupon. But actually, Bret, if you can hear me, and if we were able to hear you, we actually do have some questions that are directed to you. I don't know if this is an area that you look at, but we have one viewer, MM, who is saying, "Hi, Bret. Do you believe the Bitcoin bull technical setup also drags other coins, Ether, Solana, etc., along with it through the coming year?" Do you follow those? Do you follow those other coins at all?
Quite honestly, no. But in answer to this specific question, I mean, what they're doing is they're driving the sector up. I mean, and so I don't see any reason why they wouldn't drag all these other coins up along with it, and vice versa. And I might add, just to your previous point about MicroStrategy MSTR, the current market cap's about 120 billion, and they've got about 46.5 billion worth of Bitcoin. So they've got about a 2.6 ratio going there. No wonder they're selling stock. That's a great deal for them. It's not the greatest deal for people who want to buy it, I got to tell you. But
yeah, I mean, I think, and actually, I spoke about this on a previous live stream, and you can opine on this because you are you're a vol trader as well. The real thing that I think Michael Saylor is trying to take advantage of, there's a couple, but obviously to the extent that there is a meaningful premium to the valuation of the equity as it currently stands that he can take advantage of. So if he can sell, just to keep the math easy, if we could say that he could sell his shares at 3 times the value of Bitcoin and then use those proceeds to buy Bitcoin, then that's kind of a nice setup for him. On the converts side, because the volatility of Bitcoin is relatively high, and the volatility of MicroStrategy, being a levered play on Bitcoin, is substantially higher, he's able to sell those converts with with no coupon and with conversion prices that are probably a 50% premium to even the elevated price of the shares. So, and of course, every time he does that, that is actually accretive to shareholders because they're essentially going to capture the value of Bitcoin differential between the conversion price on the convert and where they're actually able to accumulate the underlying Bitcoin. And that, of course, is something he talks a lot about. Let's see here. So InvestWise asks us, what should be the approach for people who have missed out on, what should be the approach for people who have missed out on this Bitcoin rally, don't want to get in due to FOMO, due to fear of missing out? What do you say to those people?
you missed it. There's other stuff available.
It is tough. I mean, I will admit that, of course, it's not surprising. Look, in the first week of January of 2024, I was asked on CNBC what my thoughts were about the best trades for the year are, and we had to come up with an acronym. For those who watch me, you'll know. And mine was BRAVE. The B was for Bitcoin. Look, it depends, of course, how you value it as an asset. It is obviously very challenging to encourage people to. I think all of the things I said then remain true today. But of course, after you've had such an exuberant rally as the one we have, it gets a little bit more challenging. So my thinking on that is this. One thing one could consider is, because Bret pointed this out, that the volatility of Bitcoin isn't that extraordinary. I mean, it's a volatile asset. This is not utilities. But, in some ways we might suggest that it could have been considerably higher. MicroStrategy most certainly is. So I would say, buying longer dated, call options, for example, if you're not trading futures the way that Bret is. And incidentally, Bret, I have a thought for you, because you were just mentioning CME futures. This is what you look at. IBIT, which is the ETF that tracks Bitcoin, has had much more uptake in the options than the CME Bitcoin futures have. So I don't know what the average. I could probably check it and see what the volume is now. I happened to be speaking at a summit in Miami a couple of weeks ago, and at that summit, CME happened to have a booth, and I asked them this very question because that was the same week that IBIT options listed, and those IBIT options traded something like 350,000 contracts the very first day. And there probably were a lot of people who didn't even realize that that was the day they were going to list. What do you think accounts for, I mean, how do you feel about trading the futures and the futures options relative to some other Bitcoin proxy like the ETF and the ETF options? I mean, other than being a futures trader, is there any reason why you would be more reluctant to look to the ETF where it seems like there's a heavier volume now?
I think people are more comfortable with the ETF because it's a product that retail is comfortable with. Retail generally, I know I'm speaking just in general. In general, is not super comfy with futures and options because of the margins, et cetera, et cetera, et cetera. It's more of an institutional product than anything else in a retail, basically in a retail environment. So this is essentially, I mean, let's call it spade a spade. Bitcoin is a retail product. It's not really a super institutional product. So that's why the micro ETF, the micro Bitcoin contract is much more popular than the regular size contract. So that's a very big contract. Retail moves into the micro contract because it's too big, and they're just, retail is going to go into a non-futures like product, in my opinion, every time. Just because they're more comfortable with it and it's just simpler for them. They don't have daily margin calls, et cetera, et cetera. And that's what they're, so, I mean, I grew up on institutional trading and, in crude oil, and I can count on one hand the number of retail clients I ever saw dealing in crude oil, that we had, and they were incredibly wealthy. So, but that's why I think they're dealing with, the ETFs and things like that. An overt generalization, but that's why I think it's occurring.
So FinWest asks us a question. Do you expect IBIT options to become available as 0DTE?
Zero DTE.
I'm going to take a quick peek. Let's just take a look at what the volume is in IBIT options today. So the availability of shorter dated expirations on the option side is typically driven by demand. So if there's a lot of speculative demand, a lot of day-to-day volume in the options, that's when you will see first weeklies and then potentially shorter dated contracts. 0 DTE would be a jump because we only have 0 DTE in index proxies on the equity side now. But we could see intra-weekly, I suppose.
No,
that's my own 2 cents.
I mean, my understanding is that, we're going to be seeing daily 0 DTEs on lots of individual stocks later on this year, especially with the new SEC. I'm pretty sure that's going to happen pretty quick.
You mean in 2025?
Yeah, next year.
Yeah,
not this year. But, I mean, they're aggressive. They're not that aggressive. So.
Yeah. I think part of my answer to this also is that one of the issues that comes up is that there is a little bit of calculation and quote traffic mitigation issues that are going to matter. So, for example, I mean, my experience as a former pit trader and, pushing quotes as running a market making operation, it may surprise people to hear that in the late 90s and into 2000, there were a couple really important dynamics that were going on the equity options side. And those were, one, multiple listing. So it used to be that there were only 4 equity options exchanges in the United States, and those were the CBOE, the Amex, the Philex, and the P-Coast. And on those 4 options exchanges, when I first started in the business, which maybe I'm not quite as old as I look, but it was, believe it or not, we were still trading in eighths and quarters. Big developments occurred when we first started to quote in teenies. So that was half of an eighth, so we're talking about 6 1/4 cents. and then the multiple listing, where exchanges that had once single listed the options on very heavily traded stocks. So, for example, Microsoft traded on the P Coast, Dell traded on the PHLX. Intel was exclusively a product on the American Stock Exchange, and some of the big industrials were exclusively on the SIBO. Due to some antitrust concerns, there was a lot of pressure. Market makers started multiple listing the products, and what happened was you combine first the teenies and then moving to nickels and then finally pennies with all of these market makers, and then the advent of additional exchanges like the ISE and so on. Suddenly it created a whole lot of quote traffic. When you have more products with more strikes and more expirations and more market makers quoting them, you get into a situation like that. Do you have any additional thoughts on that, Bret?
Honestly, not really. I just know that they're incredibly popular. I mean, it's kind of, I've written about this in the past, that the line between sports betting and zero DTE options gets kind of fine after a while. And there's also some valuation issues. Is how exactly do you value a zero DTE option, with a couple of hours to go? This isn't a normal implied volatility, Black-Scholes sort of exercise. There is no implied volatility. It's meaningless. So it's almost a supply-demand driven price. And it's really difficult to tell, am I overpaying for this thing or am I underpaying for this thing? Because it's sort of a digital answer. I'm used to trading volatility. I'm not really trading price. To this is you're just trading a price. Either it's in or it's out. It's a very interesting product. It would suit Bitcoin perfectly, I have to tell you. It really would. But they're coming, and they're coming hard this year or next year. Sorry.
Yeah, I think I agree with you on this. I mean, look, the listing of financial products, to the extent that financial regulators and exchanges are willing or able to accommodate them, is going to be dictated almost entirely by investor demand. And it is very clear when you take a look at the high concentration of options volumes in a relative handful of underlyings, and those would include things like MicroStrategy. It's going to include things like NVIDIA, and it certainly includes Bitcoin and its proxies outside of the CME futures options, which I think people should probably look at more, but I understand that if people don't have futures accounts or less comfortable with futures, and the most important thing I would just point out to anybody who's watching, who's thinking about trading options on futures, is that right now, Bitcoin futures, because they're trading in contango, it's probably less of an issue, but an important thing to remember is that when you trade options on futures, the underlying is very likely not what you are tracking every day. So you look at the spot price of Bitcoin, or you look at the spot price of oil, or you look at the spot level of S&P volatility, which is what we would call the spot VIX index. But when you buy a call option that goes out 4 or 5 months in the VIX on the futures side, you are buying an April or March VIX futures call. And that future, the behavior of that future can deviate sometimes very materially from the front end of the curve. That's not as common in something like Bitcoin at the moment. It seems to trade more like a currency, doesn't it? Don't you think? Kind of like gold or silver futures. It's kind of right. It kind of looks right now. They seem to be behaving like that as a curve, meaning that you're not. For now, it doesn't seem like there's a big disconnect, but there may be some fundamentals in there. Let's see. We have another question here from, okay, you say Bitcoin is a product, but what is the true use case? NFL players paid in Bitcoin are happy today when they convert to dollars, but are they benefiting from hype begets hype, or is there utility? What do you think about Bitcoin utility, Bret?
As long as I can answer without getting trolled to death, because I've never seen I've been on Wall Street a long time. And I have never seen a commodity, a product, an asset class that has caused more evangelical fervor than Bitcoin. That if you look at some of the discussions surrounding it, that if you're not a believer in Bitcoin, they come after you with great guns as to, we're trading against the world, the U.S. dollar, and it's a font of value in a geopolitical mess, et cetera, et cetera, et cetera. Personally, I have a real hard time coming up with a use case for this thing. And I mean, honestly, I think if you look at Bitcoin, at least on the futures and options side, more as a meme stock than as an actual thing that we can actually use to pay for something, then I think you'll be much more comfortable with the thing. Coming up with a use case for Bitcoin, I don't know what it is, frankly. I really don't. But I'm not an expert in this, but I can't come up with a good idea. Like, what are we doing with this exactly? What is wrong? Yeah, I just can't. But other people can, and more power to them.
I think you just hit on something very important, which is whether or not there is utility depends on the general perception of other participants in the space. And what I mean by that is, what's the underpinning value of the dollar other than the full, while we have a fiat currency, other than the full faith and credit of the United States government to pay it back in dollars? I mean, we don't. There isn't necessarily, you cannot go and turn your dollars in for something. It's a medium of exchange. It is a way to store value, to store work. I think people see that is the utility of Bitcoin. The thing that Bitcoin has as a potential benefit is that there's a finite quantity of it, first. Secondly, it is viewed as a secure means of payment due to the distributed ledger concept. And it has anonymity. So one of the benefits it has is, so writes, it has the same utility as gold. I would say that there are some who would argue, well, first of all, gold does have actually some physical properties that make it very useful. It is an exceptional conductor. It is used in heat shielding. It is, on my finger to designate that my wife is still with me. We'll see how long that lasts. But the purpose of Bitcoin, one of the big benefits that Bitcoin has is that it is a tremendous electronic means of payment across distances where currency such as cash or physical metals or other things cannot be. And as an example that I would provide for this, imagine the following. Imagine that you needed to pay somebody today, tomorrow, this week in Paris. You had to pay them $1 million. Well, and you wanted to do so anonymously. Well, you can't really do that. If you tried to wire them money with a bank account, or if they tried to wire it to you, there would be AML laws that would probably play into that transaction, and you would probably have a hard time doing it. You can't, stuff $1 million into a briefcase and hop on a plane and expect to make it through security. And you certainly can't do it even with gold. So the utility, I think, and actually some people who are opponents of Bitcoin will point to this issue and say that its principal utility is for anonymous payment, possibly by nefarious actors. So that's a possibility. We have a question here from Tucker D. Dog. Biggest risk to Bitcoin? Question mark. Quantum computing. What do you think the biggest risks are to Bitcoin?
That's an interesting. I mean, it's an interesting question, but not for the reason that I think that the person wrote. What's interesting to me is somebody who follows Wall Street trends, is that it's amazing to me how certain things become the thing all of a sudden. and they were perfectly in sight 2 or 3 weeks ago, but something happened, some switch got flipped. And in this case, it was quantum computing suddenly became a big deal about 3 weeks ago. I think because Google announced something or other. But now, all of a sudden, quantum computing is going to become the next big thing. And we are far, far, far away from having quantum computers sitting on our desks, believe me. So it's not it's a risk to Bitcoin very long term, probably, but I'm talking very long term. I mean, but to me, it's just more of an interesting thing in that the trends that Wall Street, when I first started trading, M1, the money supply figure, was the thing that everybody watched. And it came out, I think, on Thursdays. Everybody was glued to their screen right after the bell to watch what M1 did, what the money supply did. This went on for like 4 years. And slowly but surely, people lost interest in it. And then they just moved on to a different fundamental. M1 was still being published every day, but no one really looked at it. Similarly, this is like Bitcoin is in now. This is like the big thing that the market is looking for. And eventually it will fade, I guarantee it. And the market will move on to something else. And the market is very kicky. And one of the biggest risks of Bitcoin is exactly that, is that we haven't really gotten a new fundamental at a lot since election day. A real, genuine new fundamental. The fundamental that's driving Bitcoin is that, Trump is kind of into Bitcoin. Who knows? But he says he's really into Bitcoin. And regulations are going to be looser. But beyond that, we haven't really gotten anything new. And markets are hungry for fundamentals. And if they don't get new fundamentals, they kind of get sick of the old one. It's almost like your kids with a new toy, where they get sick of it, and eventually it kind of winds up on the steps going down to the basement. And then eventually it's in the basement, and they no longer even know about it. It's very similar with fundamentals. So we haven't gotten a new fundamental in a while. We made new highs today, which will impel some new buyers, but eventually you need some new juice here. It's what's going to have to happen.
Before I let you go, let me ask you this question, because I'm sure some of the folks that are viewing today are in the space. I have personally encouraged people to be in the space. I guess as somebody who watches volatility, and also the futures curve. So we've seen what the futures curve looks like right now. You've made some observations about volatility. What are the three big, as somebody who trades futures, I mean, I'll just throw out one of mine, a downside reversal, something gaps open to a new all-time high and then closes lower. One of the bearish things that I say, I don't care what this is, and I don't care what the story is, I don't want to own it. So I was never a technical guy. I was more fundamentally driven, but that was always one of mine. And another one in the volatility space that had me concerned, because I saw it during the tech bubble, was that in equity land, generally speaking, the volatility and the implied volatility for the index, let's say, stays constant or drops as the market steadily marches higher. In the tech bubble in late 99 and in early 2000, I saw that prices were rising and volatility was rising at the same time, which seemed unusual. So those are two things that I think about that get me anxious. What are a couple things that get you anxious?
The last one that you said about the implied volatility is really interesting, because in order to understand implied volatility, you can use implied volatility to kind of figure out which way the market thinks is the scary side and which is the comfortable side. Like in crude oil, when crude oil comes off, implied volatility goes up hard. And when it comes up, it tends to come down. Similarly with stocks, because people are comfortable with stocks increasing and they get kind of antsy when it starts coming off. Except if you're getting an extreme move. So like if Bitcoin starts getting very extreme to the upside, you'll start seeing implied volatility come up instead of staying stable. I think when you start seeing that, that means that people are starting to get increasingly anxious that the upward trend can't sustain itself, similar to what you said about the tech bubble in the early 2000s. When you see something like that, I think, or if you start seeing the out of the money, the at the money skews get very extended, like over 10 or 15%, that's when you know people are overpaying radically for out of the monies and they're paying too much for this stuff. So their expectations.
And when you're saying 10 to 15% skews, are you? I think your chart was comparing 20 delta calls to 50 delta options.
Yeah,
is that right?
Exactly. And when I say
So that,
10 to, I'm saying percentage points. So one is trading 65, one is trading 50, for example. When you start seeing that historic relationship get very wide, much wider than normal, and it's accompanied by you're seeing volatility increase as Bitcoin comes up, and you're seeing excessive volume, then you know this thing is getting kind of scary.
Sunny Saki asks us, if I hope I pronounced that correctly, your thoughts regarding IBIT Jan 2026 calls. Is the price a fair value given its volatility? And since, Bret, I know you probably don't have that up on your screens right now, I am going to take a look at it, and maybe we'll be able to see it together. So let me just bring up the January 2026 expiration with our handy-dandy Bloomberg terminal, which, by the way, whenever it's something I haven't mentioned all the time, but just so that everybody who's watching knows that in some markets generally, a lot of quotes drop away within the last few minutes before they close as market makers either widen out their spreads or move away. So the closing prices that we see when we do this exercise may or may not be that reflective of where they would be in actuality. What we're seeing right now, IBIT is $60. The implied forward is 64.59. So what that means is that we're probably going to find that the 50 delta calls and puts are going to be right around, they're going to be a little bit higher than the current stock price. So I'm just taking a look at, let's just say, the 62 or 63 strike. We'll take a look at the 62 strike calls. Those are about $18. It looks like the midpoint for volatility is 68%. So 68% implied volatility for the IBIT ETF, which does track spot Bitcoin pretty closely. How does that vol sound to you, Bret?
Doesn't sound abnormal. That's for sure. It sounds more or less like market, frankly. Without knowing a ton about it, but that's my opinion. It seems pretty basic to me.
Yeah,
it does
so
stand out.
I'm just going to take a... Yeah, I mean, I would expect all of these things to... I mean, first of all, the options on IBIT are a relatively new product, having only been listed for a few weeks.
Oh.
Most of the flow, the customer flow, and as Bret pointed out, these are retail products. My guess is most of the flow is long. So that means that the initiating side of the options flow are net buyers. And what I'm seeing is that the average volatility, let's just take a look at what the average volatility going back 6 months is. So the mean is about 57. So that means that the 1 year call options, at the money call options, give or take, are trading at about an 11 vol click premium to realized going back the last 6 months. And that's not to say that... So questions you should ask yourself as an options trader on whether or not you're getting a fair price is, do you believe that the realized volatility of the underlying asset, in this case IBIT ETF, but really the underlying asset is Bitcoin, do you believe that the realized volatility is going to fall considerably over the course of the next year? I have an answer. I'm going to ask Bret for his first. Do you think that realized volatility for Bitcoin is likely to fall significantly? And by significantly, I'm going to, I'm not asking you to make a precise, calculation. Over the course of the last 6 months, the trailing realized volatility got about as low as 45 or 6 and as high as almost 70. Do you really see it trading materially outside of that range to the downside over the next 12 months?
Over the next 12 months. Let me preface my answer with a caveat, is that the regime that we've been trading, it's important when you're looking at realized volatility to look at how long the series is. A 6-month series of standard deviation is not necessarily representative of the current market. Bitcoin has been rallying since November 5th, which is just really a month and change ago. The conditions of 6 months ago aren't really valid, aren't really applicable to the current conditions. This is why it's a classic debate: implied volatility versus realized volatility. What's the connection? In my opinion, there isn't much of a connection, because implied volatility is looking forward, realized volatility is looking backwards. Implied volatility has a premium on top of it for the uncertainty factor. So if you're telling me that realized 6-month volatility is 58 and current implied volatility is 68, you got a 10-point VIG essentially for uncertainty stuck in there. Which to me, frankly, with what's been going on in Bitcoin lately, it doesn't seem like a very high number to me. I think let me caveat another way. If you're a veteran of certain other options like natural gas or crude oil or some meme stocks, you're used to triple-digit volatility that goes up and down by 20 percentage points a single day, or even sometimes more. Volatility, they'll just rip your face off. So to me, this thing's making new highs. You're trading volatility like in the early 60s, low 60 implied. That doesn't seem like a very big number to me compared to other stuff I've seen that seem like a lot deeper markets that to me almost have less risk in it than Bitcoin does. So Bitcoin's implied volatility seems cheap to me, frankly, just on a relative basis.
It doesn't seem, like I said, the flow is primarily, my guess would be, I'd be rather surprised if there's a lot of retail premium sellers on the option side in Bitcoin. It's not speculative assets. People are not usually looking to clip coupons and make dividends. They're looking to knock it out of the park, and you don't do that by selling options. I actually have a 10-year chart of realized volatility for Bitcoin itself up on my screen right now if we want to pull that up. But in support of what you just said, Bret, I can remember quite distinctly, and we were just talking a little earlier about shoulder months in natural gas. I was on the floor of the New York Mercantile Exchange when natural gas went from 6 to 12 in an hour.
Yeah. Yeah.
So a 100% move in 1 hour is not volatility that I think anybody who's used to equities can possibly contemplate. And natural gas, for what it's worth, was a really stable price compared to electricity. So electricity, for those who've ever seen what the electricity markets can do, it's almost unimaginable. I didn't trade them. We thought about trading them, but it was incredible.
I traded power for a little while, and imagine being short a $200 call, and the underlying is trading 5,000. I mean, these are the sorts of swings you see where it's just like, all right, I don't even know what to do. But even with Bitcoin today, it made new highs. But on a percentage basis, we're talking, 2%, something like that. We're not seeing like gigantic, they seem higher than they are just because of the press and the hype surrounding it. But when you look at like the daily percentage changes, they're not that impressive compared to other commodities that I've seen go completely crazy, honestly. And I think that's one of the reasons volatility is kind of subdued.
Yeah, one other thing I would also point out on the volatility side, if we can pull my screen up one more time just so people can see it, and this is the term structure of volatility for IBIT options right now. A week ago is what we see in red. Current is in white, so short-term options have fallen off a little bit. But I think it's important for those of you who are looking at this to remember that if you can't, this is not like for like. Because a week ago, those options were looking at this week. This week, looking out, we're going to capture next week and so on. It's a rolling thing, just like with the VIX. And what we're now going to start capturing as we look at these really short-dated options, for example, the ones that expire on the 27th, next week is a holiday. We've got a half day and a day off. And you put those two things together, and you're going to have a little bit lower volatility because the market's not open the whole time. So
I think I'm
going to go ahead.
I think one of the answers you have to come up with to the person that asked whether it was fairly valued or not is when you're looking at implied volatility. Imagine yourself being short implied volatility and you have to hedge yourself in the underlying. How difficult is it to do that? If the answer is it's not that too difficult because it's an orderly market and bid offers are kind of tight and I can get it done pretty quick, then you don't really have to charge a serious premium for implied volatility. But if you're into something that's whipping around during the day and it's really hard to hedge, then you charge a lot more for implied volatility. And so far, as I've said a couple of times, Bitcoin doesn't seem to me to be, to be one of those commodities that's just whipping around irrationally, like natural gas or crude oil or power or one of those things. Hence, it's trading at like 60%, which is lower than you would think. But when you really look at it, you go, yeah, probably.
That's actually a great point, and I think we're probably going to start to wrap it up here, partially because I also have another show coming up right after this one, CNBC's Fast Money, which I'm going to be on very shortly. That show has already started. It actually started at 5 o'clock Eastern, which probably those of you who watch CNBC would know. But Bret, it's really been terrific having you here, and I hope we get you back because... and maybe with a little bit more lead time. So just for those of you who are watching, this is something that we decided to do at the very last minute, late last week, and then actually almost didn't happen because I screwed it up and conveyed an email confusing the East Coast and West Coast times, which is inexcusable given how much time I spent in both places. But Bret, I really, really want to thank you for coming on today. I've enjoyed your insights tremendously, and I hope we get you back really soon.
It's my pleasure. Thanks for having me.
All right, everybody. So for those of you who have any additional questions, we might be able to pass some of those on to Bret. His firm is Winhall Risk Analytics. He also gets all of his data from OptionsMetrics. We've used those guys before. Like, subscribe, send us your comments, and we are going to be back live again, 4:15 Eastern Time. I'll see if I can remember what the time is on Wednesday. See you here.